Hello everyone, and welcome to Virginia International University's MBA 605 Auditing course. Today we're going to talk about the last chapter in our text, chapter 26, which deals with internal and governmental financial auditing and operational auditing. It takes a slightly different twist to the role that auditing plays with respect to the organization. Up to this point, we've generally been talking about the financial statement auditing and the phases and all of the processes inherent to that, and as you recall, the business cycles, the audit report. We also talked a little in chapter 25 about the other assurance services differently than audit, to include compilation and review and special engagement or other engagement activities. And so now we're going to turn our attention to something a little different from that it still offers a very viable career for many people. And in order to understand that, we're going to talk about internal auditing and the role that auditors play in financial auditing. We'll describe the auditing and reporting requirements under the Government Auditing Standards and the Single Audit Act. We'll talk about the difference between operational auditing from the financial auditing we've been talking about up to this point. We'll also get a better understanding of operational audits and how we would plan and perform an operational audit. And so internal auditing is an independent activity within a company whose objective is to provide assurance and consulting activity designed to add value and improve an organization's operations. The New York Stock Exchange requires its registrants to have an internal audit function. The internal audit is intended to provide value through improved operational effectiveness while performing traditional responsibilities. And so what an internal audit function would do would be to review management information that's generated internally for accuracy. It would ensure compliance with applicable laws and regulations, and it would be responsible for safeguarding assets such as inventories. The Institute of Internal Auditors is a professional nonprofit that provides a lot of guidance to the practice of internal audit throughout the world. It has established certain ethical principles, such as integrity, which establishes trust and provides the basis for reliance on their judgment. Internal auditors make a balanced assessment of all the relevant circumstances and are not influenced by their own interests or by others in forming judgments. Internal auditors also respect the value of information they receive and do not disclose information without appropriate authority. And so that gets to the confidentiality principle. And then finally, with respect to competency, internal auditors apply knowledge, skills, and experience needed in performing internal audit activities. And there's also several certifications. One of them is the Certified Internal Auditor that's widely recognized in the internal auditing profession, similar to the CPA. There are also certain rules of conduct that the Institute of Internal Auditor professes. So internal auditors should perform their work honestly, with diligence and responsibility. They shall not participate in any activity or relationship that may impair their unbiased assessment. They shall be prudent in the use of information acquired in the course of their duties, and they shall engage only in those services for which they have the necessary knowledge, skills, and experience. So in the previous slide we talked about the ethical principles, and in this slide we talk about the rules of conduct established by the Institute of Internal Auditors with respect to internal auditing profession. And so here we can see that the relationship of internal and external auditors. The internal auditor is responsible to management. The external auditor is responsible to financial statement users. Both must be competent, objective, and they both use a similar methodology and consider risk and materiality in determining what to test. With respect to governmental financial auditing, the primary source of authoritative literature for the performance of government audits is the Government Auditing Standards, which is issued by the Government Accountability Office. Because of the color of its cover, it's usually referred to as the Yellow Book. And we see government auditors, examples of government auditors might be the inspector generals. We have the Defense Contract Audit Agency, which is a large auditing agency arm of the Department of Defense. Each agency within the government usually has its own auditing arm, although some are much more limited and much more specialized in how they focus. But in general, all of these audit activities should conform to the standards and guidelines espoused in this yellow book. And here then, when often in those circles, the yellow book standards are often referred to as the generally accepted government auditing standards, or GAGAS. And we see that with respect to this yellow book, it's intended to provide guidance with consistency with respect to generally accepted auditing standards to result in some qualitative considerations around materiality and significance, quality control, quality reporting, and compliance auditing. So the audit should be in accordance with generally accepted government auditing standards, or GAGS. The auditor must obtain an understanding of internal control of the federal programs sufficient to support a low assessed level of control risk for major programs. The auditor should determine whether the client had complied with the laws, regulations, and the provisions of contracts or grant agreements that may have a direct and material effect on each of its major programs. And all of this is with respect to the Single Audit Act and the Office of Management and Budget Circular A-133. And so these may be auditors who are auditing grant recipients or grantors, or the government who issued the grant. And so with respect to the reporting requirements, an opinion on whether the financial statements are in accordance with GAAP versus an opinion as to whether the schedule of federal awards is presented fairly in all material respects in relation to the financial statements as a whole. And then we have a report on internal control related to the financial statements and major programs, maybe a schedule of findings and question cost, and a report on compliance with laws, regulations, and the provisions of contracts or grant agreements. And so now let's turn to talk some about operational auditing. So the limited distribution of operational reports and the diverse nature of audits for efficiency and effectiveness allow operational reports to vary considerably from audit to audit. And we see that the purpose of operational audit is to determine the effectiveness or efficiency of any part of an organization. Financial auditing emphasizes whether historical information was correctly recorded, while operational auditing emphasizes effectiveness and efficiency. And so it's important when we're talking about effectiveness versus efficiency to distinguish between the two. So effectiveness refers to accomplishing our objectives. So did we set out to do what we said we were going to do? Efficiency is defined as reducing a cost without reducing effectiveness. So did we get to where we wanted to get to at or below where we were budgeted to get there? Which is the difference essentially between effectiveness and efficiency. And so here we see a few examples of inefficiency. So acquisition of goods and services is too costly. The example of that would be bids for purchases of materials are not required. So because we didn't competitively bid acquisitions, we paid too much for what we did buy. Raw materials not available when needed are an example of something that would be considered inefficiency, and the result of that would be that the assembly was shut down for lack of materials. And so these are just some examples to help point out how we think about efficiency, or in this case, inefficiency. And just a few more examples. There are too many employees. Office work could be done with one less assistant. So they're generally common sense type examples, but again, we're stressing the difference here between inefficiency versus effectiveness. So now we want to talk some about the relationship between operational auditing and internal controls. Internal control evaluation for financial auditing has two purposes: to determine the extent of substantive audit testing required and to report on the effectiveness of internal control over financial reporting. And we talked about those throughout the semester with respect to internal controls over financial reporting. With respect to operational auditing, the scope of operational auditing concerns any control affecting efficiency or effectiveness, while the scope of internal control evaluation over financial audits is restricted to the effectiveness of internal control over financial reporting and its effect on the financial statements. So we can see that we have two completely different objectives of controls, depending on whether we're looking at the control from an operational auditing or a financial reporting perspective. And so we have these different types of operational audits. A functional audit deals with one or more functions in an organization concerning the efficiency and effectiveness of that organization, such as a payroll function for a division or for the company as a whole. An organizational audit emphasizes how efficiently and effectively functions interact. And then we have special assignment operational audits that arise at the request of management for a wide variety of audits, such as determining the cause of an ineffective IT system or investigating the possibility of fraud. And so who performs operational audits? Many internal audit departments do both operational and financial auditing. To maximize effectiveness, the internal audit department should report to the board of directors or president. We want to maintain that independence with respect to internal audit. Different federal and state government auditors perform operational audits as a part of doing financial audits. And then we have non-public companies which often engage their CPA firm to do operational audits of one or more specific parts of its business. An example would be the efficiency and effectiveness of its computer system. Public companies cannot engage their financial statement auditing firm to perform operational audits. So I'll say that again because it's very important. Public companies cannot engage their financial statement auditing firm to perform operational audits. This would result in a conflict of interest. All right, the independence of internal auditors is enhanced by having the internal audit department report to the board of directors or president. The auditor should not be responsible for operating functions in a company or for correcting deficiencies when ineffective or inefficient operations are found. That gets to this idea of independence. If they are responsible for the operating functions or they are to correct what the problems that their audit identified, they lose this view of being independent. While it is acceptable for auditors to recommend changes in operations, operating personnel, not the auditors, must have the authority to accept or reject those recommendations. So more specific criteria are usually desirable before starting an operational audit. And this is because we need to, again, understand where are we now with respect to effectiveness or efficiency. We need to understand where do we want to be. For instance, where are our competitors or where are similarly sized firms with respect to this, and that's where benchmarking comes in. And then once we have these criteria, then we can start our operational audit. And so now we'll talk and conclude with respect to the phases in the operational audit, which include planning, evidence gathering and evaluation, and reporting and follow-up. The operational auditor must determine the scope of the engagement and communicate it to the organizational unit. The 8 types of evidence are equally applicable to operational auditing, and in operational audits, the report is usually sent only to management with a copy to the unit being audited. The diversity of operational audits requires a tailoring of each report to address the scope of the audit findings and recommendations. And so to some extent, we can see that this operational auditing, the phases are at a high level the same as the phases of a financial audit. We've got planning, we've got evidence gathering and evaluation, and we've got reporting and follow-up. It's just when we start to execute the audit, we have, as we get lower and lower into the execution plan, we have some very different steps that are applicable to the operational audit and not to the finance, that may be applicable to the finance and not the operational audit. And so this concludes Chapter 26's discussion. I encourage you to go back and read the chapter. It's an interesting and important chapter. Keep it in mind, for a lot of people, public accounting is not a career path for them for many reasons. And I found that in many cases, an internal audit role gets a person into a company, gets them understanding how that company works, what's important to the company, what are the processes, what are the procedures, how does it operate, and then they use that role in internal audit as a stepping stone to other roles in that company, other management roles in that company or another company, similar to that same path for CPA firm auditors, but it just starts out at a different place. So I do encourage you to read it from that perspective as well. And I appreciate your time and attention to this discussion of Chapter 26. Thank you.